Welcome to Retirement Unlocked with Larry Heller. Your life, your way, unlimited possibilities. Join us as we explore how tailored financial planning and investments can help you navigate life transitions with confidence. Let's dive into this week's episode.
Hello and welcome to another Retirement Unlocked podcast with your host, Larry Heller. Today, we're going to answer the question, how much cash should you have in retirement? All right, Larry, where do we begin?
Yeah. So, the first thing I actually talk about when we're talking about this is there's the financial decision and there's the sleep factor. And a lot of people have different versions of this and how well they can sleep by knowing how much cash they have, but also trying to figure out how to ride out when we go through an economic downturn, a stock market downturn. So everyone loves cash when we have a market correction, but when the market is doing really well, they're not so happy with cash because they think they can earn a lot more money. So how do we come up with the right amount of cash? And especially if you guys are close to retirement, I don't care how much money you have. When you first cross over and you no longer have that spigot of earning money coming in and you get that jolt from a stock market and maybe even interest rates going up, and you see on your paper that your value of your account is down, you kind of get a little antsy about that. So how can we make sure that you have enough cash? You don't have to worry about those times. And we're going to talk about some of the steps that you can put in place so you don't have to worry about that.
Well, and worry is a huge emotion that I know that you deal with all the time when it comes to helping people prepare for retirement. And so there's emotion surrounding cash too, yeah?
Yes. So, again, when the stock market is going down, people are like, I want to have some more cash. And when it's going up, they're like, why do I have so much cash there? And, I just was thinking about this and I'm like, some of the sayings that I hear from people during these times when the market is down and, some people say, I want to wait for things are better before I start investing the cash, or I need to stop the bleeding. So I'm going to sell more to put in cash, or I just want to protect my principal.
Mm-hmm.
And then, when the market's going up, people are like, why do I have so much in cash earning very little interest when the stock market is doing well? Or why should I sell these? They're doing so well. Why should I sell this and put it into cash? And again, this is all psychological, and we kind of want to do just the opposite. So we're gonna get into that a little bit more. So how do we determine the proper cash amount in retirement? Well, there's a systematic way that we do this. Well, the first thing that we ask everyone to determine what your expenses are. I'm still flabbergasted that people are about to retire and they don't know how much money they're going to spend. So we've talked about some of the tricks and trades in a previous podcast and how you can determine that, but we really want to find out, what are your expenses going to be on an annual basis? So not only just the monthly, but any big ticket items, what are they going to be annually? So that's the first thing we want to do. So just hold that thought for a second. And then we also want to talk about the risk tolerance, so we know kind of how much risk and what they're comfortable with. And then when we start with what we call communication and education. So I thought today I would actually pull up a chart that we use to explain some of these scenarios. So this is a chart of the bull and bear market, long-term benefits of stock investing. So, but you may say, Matt, why are we talking about stock investing? What does that have to do with cash? So here's how it has to do with cash. So this is a performance of the bull and bear market. So a bull market means a rise of 20% and a bear market means a fall of 20%. So going back to 1945, right here on the bottom here. And by the way, if you're listening to this, we'll include the map as part of the show notes. So on the bottom here, you can see all the times that the market has fallen more than 20% from 1945. And some of them have to do with some events, the oil crisis, the global pandemic, COVID, the tech bubble. So Matt, what do you notice here that's kind of similar with all these kind of bubbles down here?
They're short.
There you go. They're short. There are 2 years, 7 months. There's 1 year, 6 months. And if you notice, the bull markets, just by looking at these green charts, are much longer.
Yep.
So that's the reason why kind of we want to be investing. And of course, past performance no guarantee of future results. But if you look at the short returns right here, that's kind of what we start to talk about. And we start to kind of figure, well, how much cash do I need to ride out these bear markets? So if we looked at these and we were showing that they're less than 3 years, somewhere between 2 and 3 years at the worst case. If you go back to the Depression, that's a little bit different. But from 1945 on, they're less than 3 years. So that's what we really start to is we want to start to kind of figure out how much cash we want to do so we can stay the course. So the worst case scenario from 1945 to now is 31 months. So therefore, we start to look at a cash kind of caveat somewhere between 24 and 36 months to ride it out. And if the market is kind of really high, we may kind of want to be on the higher end of the cash. If the market has already had a correction and was spending down some of the cash, maybe on the lower end of the cash. So what does this kind of allow us to do? It allows us to ride out those downturns.
Mm-hmm.
So when you add the cash, and maybe you want to add some big ticket items or emergency funds in there, we're starting to have a conversation of what you're comfortable in cash, because I know that eventually we're going to go through one of those bear markets again. I don't know when the bear market is going to happen, but it is going to happen at some particular time. And that's when we really want to be prepared for it. So when you're about to retire, you have this amount in cash, and then we actually put together our reservoir strategy. So for those of you listening, episode 119, we talk about more about the reservoir strategy, but here's where we talk about the short-term investments in our reservoir strategy, that we're having that cash reservoir to ride out those downturns. And from that cash reservoir, each month, money is going to you just like you were receiving your paycheck from when you were working. So each month you're getting your regular paycheck. That cash reservoir is filled back with dividends and interest. And when the stock market is doing well, we're going to replenish that cash reservoir by selling some of their stocks when it's high and putting that into the cash. So we're always replenishing that. So psychologically, what is now happening? What is happening is that you no longer have to kind of worry about where your next money is coming. You're not thinking, oh, it's down and I'm pulling money when it's down. So that's kind of how we put together these cash decisions. And by determining kind of what your education, what the calculation is, what the communication is really putting together a nice strategy for your cash.
And when you say cash, I should have asked you this right at the beginning. Are you literally saying just money in a checking account, or can you define what cash means before we wrap up today's show?
Yep. So cash is actually, it could be in a money market, maybe in a short-term bond fund, but basically something that's not going to fluctuate very much. When we don't want to just in checking making no money, but you can want something that is not going to fluctuate at all. So there's no variability and not have to worry about that. So when we kind of put together all of this between kind of educating and then calculating the amount, calculating what your reservoir strategy is going to be, because that's different for everyone else. Everyone is different on what their expenses are. People are different in what their risk tolerance are. So we put together the reservoir strategy. And then the communication. One of the things that I start telling people right from the start is when through these downturns is don't listen to the headlines in the media. Don't listen to the markets, because now even 1,000-point drop in the market is not very much. So don't listen about, because you can say, Larry said, between our cash and our reservoir strategy, we're well prepared. It doesn't make a difference what's happening in the market, because the money that's invested in the stock market is that long-term reservoir. So we don't really care what's happening in the short term. Yeah, we don't like seeing it down on paper, but we're not going to have to sell when it's down. And that's really the key to this whole thing, is not having to sell when we're going through those bear markets, those time frames that we showed about over the course of the last close to 100 years. So, and I'm happy to say we really get called because of this, because we've already had these conversations, prepared someone, especially someone going through it for the first time. They're prepared that this is going to happen at some time during their lifetime.
Now, you just said something that, and I actually haven't heard you say this before, but you just really hinted toward it before we wrap today up, which is what a lot of people are doing is they want to buy stocks when things are on the way up, and they want to sell stocks when they're on the way down. But that's not, it's the old school lesson of buy low, sell high, right? And that's a huge part. And especially when you're talking about replenishing the cash accounts. Yes?
Yeah, no, it's a huge part. So again, that's what we talk about, the risk tolerance. So we kind of see how much equities make sense for you in retirement. Remember, if you're retiring at 65 and you're married, there's a good chance that one of the two of you are going to live to age 90. That's 25 years. So we want to have some equities, but the right amount of equity exposure that we have to stay ahead of inflation depends upon your particular situation. But when that equity grows above that target allocation, we want to sell some of the profits. Maybe we don't time the high, but we want to sell at the high. And there are times, if we do have a major correction, that we're taking some from the intermediate reservoir and we're buying some of the equities, and we're buying low. And again, that's just totally opposite of human nature when they're seeing things that are, why are we buying something? This fund or this ETF is down. It's been down for a year. Why are we buying it? And that's the whole idea of buying low and selling high.
It's on sale.
Exactly.
I'm sorry, just to put that into the, you can buy something that you want when it's 40% off. You don't hesitate to do that. But when the stock is down 40%, you're freaking out, or the ETF. So, all right. So Larry, if somebody wants to reach out, where do they go?
Yeah, so they can go to our website at hellowealthmanagement.com, or feel free to give us a call at 631-248-3600.
Well, thank you for tuning into this Retirement Unlocked podcast. If you found this episode helpful, please make sure that you like, subscribe, and of course, share it with somebody. Big picture question for this one is, if you don't have this strategy, or if you know your friends don't have a strategy like this in place, this is the perfect podcast for you to share. And if you want to take the next step, in the episode description below, you'll find the link to Heller Wealth Management website and resources, and the option to schedule a free complimentary 20-minute call with one of the people on Heller Wealth Management's team. So your ideal retirement starts with a conversation. Let's get started. We'll see you next time on Retirement Unlocked.